713,502.
That's a big number. It sounds like a lottery jackpot or something.
It really does. But it's the number of Bitcoin held by the company Strategy, formerly MicroStrategy, as of, well, right now, February 2026.
And just to give that some scale, we're talking about roughly 3.4% of all the Bitcoin that will ever exist.
Ever. It's a staggering amount of wealth concentration.
I mean, you'd have to go back centuries maybe to something like the Dutch East India Company to see a public company hoard one asset like this. It's pretty historic.
But here's the part that makes this deep dive so interesting and frankly a little weird. We're looking at their Q4 2025 earnings report.
Yeah, which just dropped.
And the headline number, I mean, it looks like a complete disaster. A net loss of $12.6 billion.
For the quarter.
For one quarter. On paper, it looks like a catastrophe.
You'd think the ship was sinking.
Exactly. If I lost $12 billion, I'd probably stop doing whatever I was doing. But then you look at what they're actually doing. They're out raising billions more, buying more Bitcoin, and you have the leadership on the earnings call basically taking a victory lap.
Calling it a massive strategic win. It's this huge corporate paradox, right? Massive loss on one statement, massive growth on another.
So that's our mission today. We are going to unpack how this software company, and I think they do still sell software.
They do, yeah, it's still there.
Has turned itself into what they call a Bitcoin Treasury company, and maybe more importantly, how they're now trying to invent a whole new asset class called digital credit.
This is really the next chapter. They're trying to become the world's first, I guess, Bitcoin bank.
Okay, let's get into it. The date is February 2026. We have to start with that number. The $12.6 billion loss. How is that not a sign of catastrophic failure?
So context is everything. That loss is, it's almost entirely an accounting thing. It's due to something called fair value accounting.
That sounds like jargon. What does that actually mean for, a normal person?
Okay, so the rules just changed. Before, companies would only report a loss if Bitcoin's price went down. They couldn't report a gain unless they sold.
Right, I remember that.
Now, they have to mark to market. They have to report the value of their Bitcoin based on the market price at the end of every single quarter.
So it's just a snapshot in time.
Exactly. And in the last quarter of 2025, Bitcoin's price dipped. It ended the year somewhere between, say, $83,000 and $87,000.
Which is still high, but a dip is a dip.
And when you hold over 700,000 Bitcoin, even a standard 10% dip translates into a multi-billion-dollar paper loss.
So it's like my house. If I check the Zillow estimate and it's down 10% 1 week, I haven't actually lost any money.
Not unless you sell it that day.
No, they didn't sell.
They did the exact opposite. They bought another 32,000 Bitcoin in Q4. So the CFO, Andrew Kang, and CEO Fong Lei, they were really clear on the call. They see this as just volatility, not a strategy failure.
So the $12.6 billion is just noise to them.
It's an accounting formality. And that's why they push everyone to look at a different metric. They completely ignore the gap numbers and focus on BTC Yield.
I saw that all over their slide deck. 22.8% BTC Yield in 2025. What is that?
Yeah, so it's not like a cash dividend. BTC Yield measures the growth in the amount of Bitcoin held per share. This is like the key to their whole model.
Okay, break that down for me.
Imagine the company is a pizza, and the pizza itself is made of Bitcoin.
Okay, making me hungry, but go on.
Usually, if a company issues more stock, they're cutting the pizza into more slices. Your slice gets smaller. That's dilution.
Right, and stockholders hate that.
But what Strategy does is they issue new shares to buy so much more Bitcoin that the whole pizza gets bigger faster than they add slices.
Ah, okay. So even though there are more slices, my individual slice has more pepperoni on it than it did before.
That's the perfect analogy. Your claim on the underlying asset grows, and in their view, that's the only thing that matters.
But that sounds like some kind of infinite money hack. How does that keep working?
It works as long as their stock trades at a premium to the Bitcoin it holds, and it has for years. They can sell $1 of stock for, say, $1.50, use that to buy $1.50 of Bitcoin, and poof, the value per share goes up.
It's pure financial engineering.
It is, and that engineering is getting way more sophisticated. This brings us to the really wild part of this report. Michael Saylor, the chairman, he said they're not just a treasury company anymore. They're becoming a digital credit issuer.
Yes, Stretch. The ticker is STRC. What on earth is Stretch?
Stretch is their new flagship product. On paper, it's a preferred stock. but you should really think of it as a kind of high-yield digital credit.
So why would I buy this instead of just buying Bitcoin or their normal stock?
Well, what's the biggest complaint you hear about Bitcoin from, like a corporate treasurer or a regular investor?
That gives you a heart attack every other week. The volatility.
The volatility. Exactly. It's up 50%, down 40. You can't run a business on that. So what Strategy did is they figured out a way to essentially split the Bitcoin. They separate the yield from the volatility.
How do you separate volatility from an asset? That sounds like financial alchemy.
It's structured finance. So Stretch STRC is designed to have a stable price of $100.
Okay.
And it pays a monthly dividend that adds up to an 11.25% annual yield.
Wait, 11%. When my savings account pays, what, 4 or 5%? That's a huge yield.
It is huge. And here's the kicker. This is buried in the transcript. For corporate investors, on a tax-equivalent basis, it's closer to 18%.
18. Why?
Because it's a dividend from a U.S. company, not interest. Corporations get a big tax break on that. The dividends receive deduction. So for a company parking cash, 11% feels like 18%.
Okay, that's a massive incentive, but I'm still stuck on how they do it. How do you promise a stable price and an 11% yield from an asset that's so unstable?
They don't guarantee it, not like a government bond, but they use the common stock MSTR as a kind of shield.
The shield.
So think of it this way. Strategy raises, say, $100 million from selling Stretch. They use that to buy Bitcoin. Now, if the price of Bitcoin drops, who takes the hit?
The company?
The common stockholders, the MSTR investors. They have agreed to absorb the first loss. The Stretch investors have a priority claim on the assets.
Ah, I get it. So the common stock investors are the human shields.
I mean, that's one way to put it. They're the shock absorbers. They take all the volatility. But, and this is the key, if Bitcoin skyrockets, the Stretch investors don't participate in that upside.
They just get their 11%.
They just get their 11%. And the common stock investors get all of the amplified upside.
So it's a choice. You want safety and income, you buy Stretch. You want high risk and amplified growth, you buy the common stock.
You got it.
Yeah.
Saylor calls it transforming capital into credit.
So is it working? Is anyone buying this stuff?
Oh, yeah. They said it's trading about $118 million a day.
That's huge for a preferred stock.
It's massive. They've essentially created a brand new, very liquid asset class.
Okay, but let's be the devil's advocate. A high yield means high risk. What happens if Bitcoin really crashes? I mean, not just a dip, but a 2022 style crash. Can they pay that dividend?
That's the multi-billion-dollar question, right? And to address that fear, they did something huge in Q4. They set up a $2.25 billion cash reserve.
In US dollars.
Just sitting in cash and short-term treasuries.
Right.
And that money is earmarked. It covers 2.5 years of all their dividend and interest payments.
So even if Bitcoin goes to zero tomorrow and they can't raise any more money, they can keep paying out for 30 months.
That's the safety net. It's designed so corporate treasurers can sleep at night.
Yeah.
And Fong Li, the CEO, he really pushed back on the idea that they're high risk. He argued they're actually under-leveraged.
How can you be under-leveraged with $50 billion of Bitcoin?
He was talking about their loan-to-value ratio. Their net leverage is only about 10 to 13%. I mean, compare that to a utility or a real estate company. They might run at 40 or 50% leverage. And a bank is leveraged way, way higher.
I guess, but at utilities, assets don't drop 50% a week.
That's true. But then he gave what I'm calling the doom number. He said on the call that Bitcoin would have to drop to about $8,000.
$8,000.
$8,000. And stay there until 2032 before they'd have any trouble paying back their convertible debt.
Wow. We haven't seen an $8,000 Bitcoin price since, what, 2019?
It feels like a lifetime ago. It would be a 90% crash from where they were in Q4.
But, I mean, we have to be honest. We have seen 80% crashes in crypto before. Is it totally impossible?
Nothing's impossible. But their whole bet, the company's bet, is that the market is different now. You have ETFs, sovereign wealth funds, all this institutional capital. They believe the floor for Bitcoin is just much, much higher now.
It's a bold bet, and they do have that software business as a fallback, right?
They do. It's almost a footnote in the earnings call, but it's a profitable one. $123 million in revenue in Q4, cloud revenue up 65%.
It's funny, the software business is like the little safety boat being towed by the giant Bitcoin battleship.
It keeps the lights on and pays the developers. But yeah, the Bitcoin Treasury is the engine.
And it seems like the road that engine is driving on just got a lot smoother. We have to talk about the macro environment they're in. They kept talking about the Bitcoin president.
Yes, this is so crucial to understanding their confidence right now. The political winds have completely shifted in the U.S.
Saylor sounded almost giddy on the call.
Well, he essentially listed off the administration's new cabinet picks.
Yeah, I heard that. Vice President J.D. Vance, Treasury Secretary Scott Bessent.
SEC Chair Paul Atkins. I mean, these are all people who are publicly pro-digital assets. And Saylor's point is that the U.S. government has gone from hostile to, well, to wanting to make America the Bitcoin superpower.
So no more regulation by enforcement.
That's the bet. And for a company like Strategy, that de-risks everything. Suddenly, banks are happy to lend to you. Institutions feel safe custodying with you. The whole environment changes.
And it all ties back to Stretch, right? You can't sell that to a Fortune 500 company if they think the SEC is about to shut you down.
Exactly. The political green light makes the financial engineering possible.
Though there was one risk they talked about that even a president can't fix: quantum computing.
Ah, yes. The old quantum will break Bitcoin, FUD.
Fear, uncertainty, and doubt. Yeah, they spent a surprising amount of time on it.
We did, and Saylor's take was very on brand. He quoted The Hitchhiker's Guide to the Galaxy.
Don't panic.
Don't panic. His view is that a real quantum threat is at least a decade away. And he talked about this Hippocratic oath of crypto, which is, first do no harm.
Meaning don't rush a fix for a problem that doesn't exist yet because you might break something else.
Precisely. But they aren't just ignoring it. They're launching a Bitcoin security program.
That feels like a very grown-up move for them.
Well, they own 3.4% of the network. They're the biggest landlord in town. It makes sense they'd want to help pay for the security force.
It's just a fascinating journey. They started as just another tenant, and now they're acting like the city's central bank.
That's a perfect way to put it.
So let's land the plane here. We've talked about the loss, the yield, the new Stretch product, the politics. For you, the listener, what's the big takeaway?
I think the big takeaway is that Strategy has created this two-track system for getting exposure to Bitcoin. They've realized one size doesn't fit all.
So there's an option A and option B.
Right. Option A is for, let's say, the learner or the conservative corporate treasurer. You buy Stretch, the STRC. You get your 11% income, low volatility. You sleep well.
You're using Bitcoin to generate dollars.
Exactly. Then you have option B. That's for the believer. You buy the common stock, MSTR. Saylor calls it amplified Bitcoin. You're not just hoping Bitcoin goes up. Your betting strategy can outperform Bitcoin itself.
Because of the pizza slice math we talked about earlier?
The pizza slice maths. The income investors who buy Stretch are basically funding the growth for the common stock investors. And the common stock investors are providing the safety shield for the income investors.
It's a symbiotic financial machine. One gets the shield, the other gets the sword.
That's a great way to describe it.
And their stated goal is to double the amount of Bitcoin per share in the next 7 years.
It's an incredibly ambitious target. If they do that, they really will have become the de facto central bank of a new Bitcoin standard.
And that's the thought I want to leave everyone with. We think of banks as these institutions that hold dollars and issue dollar-denominated credit. Strategy is holding what they call hard money Bitcoin and issuing their own credit against it.
It really makes you question what a bank even is in the 21st century. Are they a software company, a hedge fund? Or are we watching in real time the birth of a new kind of financial institution that operates completely outside the old system?
$1 trillion experiment, for sure. And
Right.
whether you're invested or just on the sidelines, you have to admit, it is not boring.
It is definitely not boring.
And that's our deep dive into Strategy's Q4 2025 pivot. Thanks for listening.
Always a pleasure.
We'll catch you on the next one.